Well, thank you so much for returning or coming the first time to our YouTube channel. I just want to thank you for being here. And, at Foreclosure Solutions North Carolina, we really seek to do everything we can to meet what your goal, help you meet your goals once you're in the foreclosure process. And we try to give good, valuable information. And today, I just a loan modification is very often the avenue that a homeowner chooses to pursue, and it's I would rank it as the second best way to handle your your foreclosure process and to get it stopped. Although I get sad sometimes because um, many of the homeowners that we talk to, and I know it's because they're under stress, they're being just swamped with phone calls from people like myself calling, saying they're trying to help. And I can't speak for those other people. I just know that what we try to do is truly be add value to what you're going through and to help you through that. Um, so today I just wanted to talk about the loan modification process again. And many people, the thing I was saying is that what I see, a mistake that I see homeowners making, and it's not fully their fault. I know it's because when they call their lender, when they're in trouble, they get the foreclosure notice, they call the lender and they want to do something to correct it and find out how can you get out of it. And so they call in and they get transferred to what they call the loss mitigation department. And the loss mitigation department is the first person that you contact is not the expert in handling foreclosures. That first person is really a customer relations person. Their role is, first of all, to represent the lender in a professional manner, to help to the best of their ability. Banks have standard programs that they use and very tight criteria that they use to determine whether you can qualify for a loan modification. But my gripe with the lenders is when you call in as the homeowner that is under distress, you're looking for answers and you're actually very susceptible you're going to grab a hold of that first thing that sounds positive for you. And I understand that. That's normal when you're under pressure. But the thing that the lender does not do when you're asking about what kind of help can they provide, and they say, well, we have a loan modification or a mortgage assistance package, or all of them really are very often just loan modifications. And so they say, sure, we've got a loan modification. We'll be happy to help. We want to help you to get back on track. And so let me send out this application to you. You fill it out, and then we'll and give us the information it's request, and then we'll be able to see what we can do about getting you on the loan modification program. Well, that all sounds very positive, but the reality is that a lot of homeowners don't end up getting a rejection, and the process takes an extended period of time. It takes a lot of your time to prepare it properly. It takes a lot of their time to make sure that they've got all the documents that they need before they even send it in for evaluation. And so you can use up most of the time that you have between the time that you get a notice of default and the sale date. Most of that will be waiting for an approval or a non-approval on your loan modification. My belief is that, and what I know from experience is that you really can have a good measure of whether you're in the category of likely to qualify or whether you never have a chance to qualify. And as hard as it may hear that you don't qualify for a loan modification, it would be a lot better to know that on the front end so that you could start making other plans and looking for other ways to solve your problem. But too many people hear, hey, we've got a loan modification, and they just sort of fill out the application and wait and only to be declined. And then they don't have many options left. I just feel like that's a disservice, especially when the lender could help you get pre-qualified. When you go in for your first mortgage, you're wanting to buy a home, what's the first thing you do? You call a loan officer and they do a pre-qualification for you. Well, they don't do that in the loss mitigation department. I don't know why, but they don't. So I wanted to help you with this today. There is a Very basic. First, I wanted to talk about the the loss mitigation department is structured. And so I bring up here I put together this little flow chart just to give you a quick explanation of how it's set up. So in order to find out your loan, whether you can get a loan modification and what the criteria are, you need to understand what the structure of the loss mitigation department is. And in that process, there really are two different phases or two different divisions or departments. And the first one, which I've already mentioned, is I call it just the intake. It's a very friendly person that is there to tell you, yes, we can help you. We want to help you with the loan modification. Oh, we have this application. We'll send it out to you. You fill it out, and then we'll see if we'll try to get that loan modification to work out for you, since maybe you haven't had one before, and they think that's a good enough reason to say, hey, it's likely you'll qualify. Not true. But nonetheless, that person has several different roles, or two major roles. One is to be a client service representative for the bank. That's nice. They've got someone for you to talk to that can help you through the beginning process. But that other role that person plays is really more of an administrative role. There's like a checklist of items that they have that needs to go along with the application that you fill out. And so you have to send all these documents into them for it to go to the other department for evaluation. So their role is, and nothing happens until they get what they call a completed file. That means everything on the checklist is provided or is explained why it's not provided. And so they're a sort of a document collection. They upload all the documents into the bank system so that it can move on to the next department. What they don't do is they do no pre-qualifying. They don't tell you whether your income is sufficient to get qualified for the loan modification or not. They don't even ask those questions. And so sometimes the result of that is sometimes a false hope that you can get qualified, and you use up all your time that you have while you're in foreclosure. So once you do get all of your application completed and the intake person, the customer relations person, has collected all the documents, all the boxes are checked, you have what they call a completed file. It goes then to the other department, the other wing, which is called underwriting. Now, an underwriter, if you've heard of insurance underwriters, people that approved your first home mortgage went through underwriters. And so the underwriter looks at he really looks at two things, very important things. One is a hardship letter. Part of your application is to fill out a hardship letter, and that hardship letter, depending on how well you write it, can help to make or break your ability to qualify. And what they want to see in the hardship letter is that, first of all, that your desire is to stay in the home, and that you have a willingness and a plan to carry out plan describing how you're going to stay in the home. And they're also looking to make sure that they really don't want to see that maybe you're in this situation because of just poor money management, because they don't want you to be in this situation again. So they're looking for a plan. But along with that plan, there has to be a financial foundation suitable for you to be able to carry out the plan. It just can't be something that's just a hope and a prayer. And so they use what they call debt-to-income ratios, just like they did when you went to get your first loan. They look at your financial standing. And there's two ratios they look at. One is called the front-end debt-to-income ratio, and then there's a back-end debt-to-income ratio. So let me give you the definitions. The front-end debt-to-income ratio, that is the measure of how much of your gross income, that means pre-tax income, how much of your gross monthly income actually goes towards the cost of your housing. Okay? And when it says housing costs, what they're referring to is basically, you've heard the term PITI, principal, interest, taxes, and insurance. So all of those things put together, most of the time, all those are included in your home mortgage payment. But if you put enough money down, your taxes and your insurance are paid outside of your house payment. And so you have to include all of those 4 categories, as well as if there's a homeowners association or any other costs associated with you living in that house on a month-to-month basis. So what is your gross housing cost? And of course, your gross monthly income is all the monies that comes into your household per month to pay your bills. Now, when the bank looks at those things, they're considering things like what we call a W-2 employee. That means you're hired by an employer, you get a paycheck from the employer, and the employer is paying your taxes, your Social Security, your workman's comp, all that kind of stuff. Now, a lot of people have a side job, a side business, a side hustle, whatever you want to call it, and that is fine. But if you want that income to be counted towards your household income for qualifying for a loan modification, then you're going to have 2 years worth of tax returns that shows you reporting that side hustle or side business job. If it is simply, let's say you have a pressure washing business that you do on the weekends to clean driveways and it's just cash in the pocket, that's nice to have, but it won't be counted in your qualifying for a loan modification. Nor is it counted when you go in to ask for a mortgage either. So the front end just has to do with your gross monthly income and your housing cost. Now, what they call the back end debt to income ratio that measures how much of your gross monthly income goes toward all the monthly debt payments. When you consider what are your debt payments, well, first of all, your housing costs are included in those debt payments. The other things that might be included in those debt payments would be things like car loans. If you have a couple car loans, that would be a monthly debt obligation. You pay it every month. If you have monthly credit card bills, very often when you get into foreclosure, you're sort of leaning on those credit cards for a period of time to, help fill in the voids of money that you maybe don't have to spend. Well, you need to look at how much are you putting on a credit card every month, and that's a debt. You would not want to use the minimum monthly charge because that's so small and that will eventually run out. But if you looked at your credit card bill, how much are you putting on your credit card every month? Count that as your monthly debt. It goes toward your monthly debt. Other things that might be on that would student government loans. That would be another thing. If you have a line of credit on your home and there's a monthly amount that goes towards keeping up on your monthly credit, any debt that you're paying on a monthly basis would also be included. So what I'd like to do, let me take a sip of water here, is just sort of go through just show you how to do those calculations. It's very, very simple math, but I just want to show you how to do it. So I'm going to try to share another screen here. If I can get it to come up. All right, took a little effort, but I got it to come up there. So the first one we want to talk about is the front end debt to income ratio. Excuse my scribble, but I just thought it would be easier for you to see how you do this. So what is your gross? First thing you need to know is your gross monthly income. So let's just say, for an example, that you totaled up what is your gross monthly income, and that equals $1,500 a month. Okay, so at $1,500 a month, I'm sorry. That's not what I wanted to say. Your gross monthly income is $4,500 a month. Per month. So that's pre-tax. It's before your tax. Let's just say that all comes from your husband and wife, and they both have jobs, they're working for employers, and that's what they bring home per month before taxes. Okay, and then the other item you need to look at is, okay, how much is your gross? How much is your gross housing expense? Okay, and so that's the same as your principal, interest, taxes, and insurance. PITI. You've heard that before. Like I said, most people have all of that included in one payment. And let's just say your monthly house payment then is $1,500 per month. Per month. So your debt to income, this is your debt, right? That's debt, and this is income. So the debt is $1,500. And the income is on the denominator. That's $4,500. Okay, and that equals, let's hit the old calculator. I'll bring that over here. So we got $1,500, and you divide it by $4,500, and that equals 0.3333. That goes on forever, right? So you take that 0.33 and convert it to a percentage. So you multiply that times 100. So I'll do that right now. And that equals 33%. 33.3%. All right, so let's go on. Let's do the other one. So this is the back end. Debt to income. Okay, so the back end is you still have the same monthly income, right? So your income is the same, and that's going to go in the denominator. But your debt will be different, because now your debt in this ratio, the back end, is your house payment plus other monthly debts or that you have to pay on. So let's just say it could be credit card, could be 1 or 2 car loans, it could be a second mortgage on the house or a line of credit on the house, could be a student government loan. But whatever those are, let's just assume that it comes up to $2,200. And so if you do the same calculation, it's $2,200. $2,200 divided by $4,500, the same gross income per month. That equals 0.489. So that's approximately 0.49. You multiply that times 100. So we'll go times 100. And that equals 48.8%. So now you want to say, okay, so what does that mean in regards to what does the how does the underwriter who is determining whether you qualify for the loan modification, how do they view that? And the standard is, now every lender can be different, and that's why I have a range here I'm going to give you. But for typically to qualify for the front end debt to income ratio, it should be between 31% to 35%. And in our example, that was 33%. So you're at 30. This example's at 33%. So I'm going to put a check there, because that would be an indication that you're within the range, that you have reasonable, not assurance, but a reasonable consideration to have some hope that you will be qualified for the loan modification. So now let's look at the other one, the back end. So the back end debt to income ratio. Okay. Now the underwriter is looking for a ratio that is in between the 45% to 55% for that ratio. And let's go back. What was yours? 48, or not yours, but the example was 48.8%. So once again, that falls within a range that you have reason to hope. You have reason to apply and put a lot of effort into it, okay? And I don't recommend that you sit back and just relax and say, oh, it's a done deal. That the underwriter still has to approve it. They still have to review your hardship letter. And if you want to look at I have other blog articles and videos that give you more detailed information about how to write the hardship letter and how to manage the lender after you've put the application in. You don't just sit back and wait. You have a lot of work to do to keep pushing it through. But nonetheless, I just thought it would be good for you to do this. If you're listening to this and you're at the beginning of your loan modification process, and you want to face the facts, you want to really find out what's your level of hope for a loan modification, then if you will go through this exercise that I've just demonstrated here, you'll know whether you would rank yourself as very hopeful or very close to the bottom, very questionable, or if you don't fall into the brackets at all, then I'm not saying don't submit the application, but I'm saying, boy, you do not sit back and wait. If you're not, if you don't have a high enough level of income, maybe, or whatever caused the hardship that got you into foreclosure is still present in your life, and your income has not been restored to a level that it was, then I see so many people just hoping for the loan that the bank will be gracious and generous. And here's the truth of it, is that they're in business. They have certain tight, even some of them are government regulated standards they have to comply with, so they can only do so much. And that's why you have a range of 31 to 35% and 45 to 55%. If you're not in those ranges, very low possibility of approval, and you need to look at other options. And that's exactly why we are here. First of all, is to help you through. If you do qualify for a loan modification, we can be here to help you through and give you lots of insights about how to do your loan modification application and the necessary follow-up really, really well, so that you get much greater assurance of the results that you want. But if you don't qualify, we're here for that scenario too. There's other things you can do. You don't need to lose your home or your equity that you built up in your home. I know it's very often natural to resist help, but if you do want good help, that's our first goal, is to meet what you want the result to be. So reach out to us anytime. Our website is www.foreclosuresolutionsnc.com. If you'll simply go on there, hit that red contact button, then we will get right back in touch with you. We'll schedule a time. We can sit down for an hour, 30 minutes to an hour, and just go over your situation. We don't apply pressure. Every decision is yours. We'll talk to you about what we call the five ways to stop your foreclosure. And so we're happy to do that. We don't charge for it. We want to be there to help you. So we look forward to hearing from you, and we hope that this video has been helpful. And if it has, I would certainly appreciate it. If you'd like to get other good, valuable information that we're putting out on a weekly basis, hit the subscribe button and you'll be notified of it. But also check out the website. There's other blogs there that are very, very informative. They'll really help you know about all of your different options. So thank you so much for joining us today, and we look forward to hearing from you if you need us. Thank you.